Hi, everyone. This is Kayla Harris, Marketing Manager at Aprio. Thank you for joining us today for this webinar on the impacts of the 20% pass-through deduction on manufacturing and technology businesses. Before we get started, I wanted to share with you some highlighting notes. To receive CPE credit for this webinar, you must answer 3 polling questions, one at the beginning of the webinar, one in the middle, and one at the end. If you have any questions during the webinar, please submit them through the question dashboard and we'll answer them at the end of our presentation. Now, let's get started.
Hello, my name is Charles Webb. I'm a tax partner in the Manufacturing and Technology Group at Aprio. Thank you for joining us today to discuss the new Section 199A deduction that came about as a result of the Tax Act in December of last year, and then the long anticipated regs that were issued by the IRS and proposed format in August. The IRS is currently holding hearings related to the regs. They had their first hearing last week, October 16th. So we anticipate more changes, but the regs gave us a good outline of where we can go and do our planning as they currently stand. So with that, let's go back and revisit just the basic deduction, what it does. So it is the 199A deduction allows a 20% deduction on domestic, and we want to quantify that and make sure we have domestic, noting that if qualified business income, also known as QBI, from a pass-through entity. It applies for years after 2017. So when we say pass-through entities, we're meaning S corporations, partnerships, LLCs, taxed as partnerships, and then also sole proprietorships such as a Schedule C, a Schedule E, or Schedule F. The whole purpose of 199A was really to level out the playing field between flow-through entities and C Corps. As you may know, C Corps got a lot of press about their reduction in the overall corporate rate to 21%. Well, Congress toyed with various ideas of how to level that playing field for pass-through entities, and what they did is they resolved to come up with this 20% deduction. So let's take a very simplistic look at how that works. Under the old law, if we had flow-through income of the net income of $100,000, we have that same $100,000 under new tax law. Your qualified business income deduction, or your 199A, is 20%. So therefore, instead of being taxed on $100,000, you're now taxed on $80,000. And then you apply your maximum tax rate. In this example, we're going to use a 39.6 in the prior year or 37 in the current year. And again, we're just using the maximum for the example, but this would be whatever your tax bracket in currently for the year. So there's a couple of initial limitations. Basically, you calculate your 20% deduction, but then there's a second limit that comes into play, which is based upon your taxable income minus your net capital gains. So there could be situations where your taxable income, either you've got losses from other entities or maybe large itemized deduction that could bring your taxable income down, that would limit that. So your 20% of taxable income is compared to the 20% 199 tentative deduction. I do want to point out that the 20% 199 is not treated as a reduction to AGI, nor is it treated as an itemized deduction. So it is only a reduction to taxable income. So keep in mind that even if you don't itemize or have a Schedule A, you still can take this 20% deduction since it's not part of your itemized calculation or your AGI. Would also note that the 20% 199A deduction does not reduce self-employment tax. But one good benefit out of this is that the deduction does result in a reduction to both regular tax and AMT tax. So as with anything in tax law, here's where the complexity starts. So this is not an official regulation categorization, but it's sort of my way to break it down into basically 3 components of taxpayers. The first is for taxable incomes below 315 for joint returns and 157.5 for a single. there are no limitations. In other words, you would merely take whatever your income is of that QBI, multiply it times 20%, and that would be your deduction. So again, no limitations for those individuals, and this is taxed. Remember, the calculation is taxed at the individual level, not at the entity level, but at the individual. So if the flow through ultimately goes to a joint return, and that joint return has less than 315 of taxable income, then there's no limitations. The second component or second bucket of the taxpayers really deals with when the income starts at 315 and ultimately a full limit applies to taxpayers who have 415 of joint income. And then I note that if you're a single taxpayer, that's 157.5 and 202. And what is that limit? The limit imposes a W-2 limit or a qualified property limitation. We'll get into this a little bit more in detail, but again, I want to make sure you understand that if you're less than 315, no limits. Once your income gets to 315, then you'll need to start looking at this other limitation, which deals with the amount of W-2 income and the qualified property. Then the next bucket, or the third bucket that I point out to taxpayers, is that there's no 20%, there's no 199 deduction for those taxpayers or entities in specified services. And that, again, using the 315, the 415, it begins to be phased out at 315, and there's a complete elimination of the 20% deduction for taxpayers joint income over 415,000 who are in specified services. And we'll go into a little bit more depth as to what is included in a specified service. So as we go back, our three buckets: no limitation under 315. Once it goes under 315, we have a phase out based on W-2 and qualified property, and then specified services. So let's discuss that second category of taxpayers that I mentioned on the previous screen. Once their income is over the limits that we had set forth, then the 199 deduction works this way. The deduction equals the lesser of 20% of your QBI, or there's a limitation based upon W-2 wages or capital. And what is that limitation? The limitation is the greater of 50% of the W-2 wages, or the sum of 25% of W-2 wages plus business from that business plus 2.5% of the unadjusted basis or the cost basis of qualified depreciable property. And I know that's a mouthful, but one way to think about this is this was where the real estate industry did a really good job of making sure that they were covered, because in a lot of real estate entities, there are no W-2 wages. So in fairness for that industry, there was this added limitation put in, which calls for the greater of the 25% of W-2 wages, or giving it 2.5% of the cost basis of depreciable tangible property. We'll go into a little bit more of what W-2 wages will count, but again, this is the overall limitation once your income goes over the income limits. So with that, let's see. Let's go through. Let's see. At this point, let's go through an example. So let's say we have an S corporation with 800,000 of QBI. We have 200,000 wages, and then we have $1 million in cost of depreciable property. As a part of our calculation, we first take step one, which is the 20% of QBI, and step two is the greater of 50% of the W-2 wages, and they're 200,000. So our answer is 50% would be 100. And then part two of the greater section of the formula is we take 25% of the wages, which is 50, plus 2.5% of the property. That equals 25,000. So our greater of 100,000, our greater of 75,000, and we get a deduction here now of 100,000. We don't get the 20% because we're limited because of the second limitation. So we'd also like to comment on what is qualified property. Generally, this is the cost of qualified. It's not the depreciated value, but this is the original unadjusted basis of that property immediately after purchase. So to clarify, the $1 million would be the original cost. It does not take into account, the way the formula works, it does not take into account the depreciable basis, nor does it take into account the fair market value of the property, merely just the original cost. So with that, we've got a polling question. Great. I think most of us have answered now. And so as we go back to remembering the special rule, the wages and property, once your income goes over a certain level, the wages and property do count as part of the 199A limitation, but interest expense does not. One of the questions that often arise, and this came about and was clarified in the proposed regs, it's very common for companies in the manufacturing or the technology world or startup companies to use a PEO, defined as a professional employer organization. A lot of folks know these as TriNet or ADP Total Source, but basically what the employee is hired, including the owner, is hired by the PEO, who then leases back that employee to the entity. So the question came up, if we have a limit based upon W-2 wages, then do the W-2 wages paid by the PEO, which is under the PEO's EIN number, do they count? And the proposed regs did come and clarify that yes, even if you do use a PEO and the wages are paid under the PEO's EIN number, then you would get to count that as wages in your limitation. So what is QBI, or qualified business income? Well, basically, it's the net of your income and expenses. But there are a few categories that we want to caution and watch out for. The first one is guarantee payments. And I'll go into a little bit more detail on the next slide. But please keep in mind that guarantee payments do not count as QBI. The other thing to watch out for is if you have losses that have been disallowed or suspended or limited in any way in the past and pre-2018 years, they do not reduce your QBI in 2018. So say, for example, you had an at-risk limitation. You did not have enough basis in taking your losses in 2017 on a particular flow-through that you were an owner in. If you now have basis in 2018 and are able to take that loss, that does not reduce your QBI. That said, going forward, the rule will change. If your loss is generated in 2018 and you carry that forward, the proposed regs clarify that the losses after 2017 will reduce QBI when allowed. So that's all losses under either at-risk, suspended losses, passive losses, or just general disallowance under the code. The question also comes up, what about S corporations? Well, I pay myself a reasonable compensation, which is out of my S corporation, which is what the code and the regs require us, is if I reduce my net income by the wages I pay myself, is that QBI? To clarify, the wages are not QBI, but the deduction would reduce your S corporation earnings that get counted as part of QBI. So in the second question, we'll know, do the wages I pay myself get counted as a deduction against QBI? And they do. So in our example, let's say we have an S corporation that has taxable income of $200,000, which includes my W-2 deduction of $100,000. So QBI is $200,000. It's not the $300,000. In other words, you would not take your net taxable income $200,000 and add back my W-2 to calculate your 20% deduction. As we mentioned on the prior slide, keep in mind that guaranteed payments are not eligible for 199A deduction. So to revisit what that tax term means. A guaranteed payment is a tax term that means payments made to a partner or LLC member to compensate that individual regardless of the profitability of the company. So often we see it when several parties come together, one of the partners or members, they may be the one that are involved full-time in the operations, where maybe the other investors or other owners are merely just investors. And as part of the arrangement, all the parties agree that one individual is going to get a set quote-unquote salary or set dollar amount. And often this is called a guaranteed payment. In other words, regardless of where the company goes, we're going to pay individual X $100,000. That guaranteed payment is treated similar to a salary paid to your other employees, and it's a deduction against the partnership net income. And as I noted, this is very akin to a salary. But the problem is if guaranteed payments are not QBI, so that would treat unfairly in certain situations one partner getting income on a K-1 as a guaranteed payment where the other partners would not, and therefore the other partners would get the 20% 199 deduction and the partner receiving the guaranteed payment would not. So if you do have this situation, we suggest highly that you reevaluate your partnership agreements, reconsider, is it truly a guaranteed payment? Is the guaranteed payment necessarily? And reevaluate who is going to get the 20% deduction. So with that, we've got polling question 2. Great, and for our polling question number 2, I think most are in agreement. This is a false statement. You cannot take the 20% 199 index on your wages as QBI. So the question that many are facing at this point is, what are the advantages and disadvantages of S corporations, a sole proprietorship, and a partnership, and how does the proposed regs impact that decision? So I guess the first thing we have to remember is, keeping in mind all those individuals, taxpayers that are below the income level, keep in mind you get the 20% tax deduction regardless of how you're structured. The issue comes in is when your income, your taxable income on your individual return begins to creep up against those limits, ultimately at 415. Whether you're in a special service industry or any type of industry, that's when the issue comes up. And then the issue that comes up is this limit based upon your W-2 and qualified property. So keep it in mind, if you're a sole proprietor and you're the only person working as a sole proprietor, there's no employees. If you have no employees and say your income is $500,000, then if you have no W-2 wages, which a sole proprietor cannot pay themselves a W-2 wage, then they would have no deduction under the 199A deduction because of the income level and the W-2 limit. The same thing could happen also with partnerships, because theoretically the W-2, the partnership could have no employees, and guaranteed payments do not count as W-2 wages. So to clarify, W-2 wages do not include guaranteed payments. So in the situation of a partnership, you may not have W-2 wages and you would be limited on the 199A deduction. So here's an example then of when the S corporation may be better and you'd want to reevaluate. because the S corporation is the only legal entity that allows the owner to pay themselves as an S corporation should be considered for that fact alone. So again, keeping in mind that as a sole proprietor, the owner cannot pay themselves a W-2 wage, and if their income is over the limit, then they would be captured by the W-2 limit and therefore not get a 199A deduction. We want to make a note that keeping in mind that noting the differences between S corporation and a sole proprietorship and or a partnership. Remember that if you are a partnership or sole proprietor, you're taxed for Social Security purposes and Medicare taxes on the full net amount of your net earnings. Whereas an S corporation, you only pay Social Security and Medicare on your W-2 wages. The part that you remove or the earnings out of the S corporation that are not in W-2 are not subject to Social Security and Medicare. So thus another reason to reevaluate the savings on an S corporation. So with that, I'll turn this over to Chad Miner to discuss the next component.
Hello, everyone. My name is Chad Miner. I'm a senior in the tax department here at Aprio. And with this new 199A law, we have special rules for specified service trader businesses, or SSTVs. These businesses do not qualify for the deduction if their taxable income is over certain limits, and then it's subject to a phase out. Now, if your taxable income is less than $315,000 married filing joint, or $157,500 for a single taxpayer, you get the full 20% QBI deduction. Now, once your taxable income goes above these limits, we start to phase out up until $415,000 married filing joint, or $207,500 for a single taxpayer. Now, what is an SSTV? SSTVs include services performed in the fields of law, accounting, consulting, actuarial science, financial services, brokerage services, investing, trading, consulting, and any trader business where the principal asset of the trader business is the reputation or skill of one or more of its employees or owners. An example of this would be a celebrity endorsement. Now, it does not include engineering and architect services, insurance brokers, real estate brokers, and trainers. Now, there are special rules for SSTVs. If a company can have part of it be an SSTV and the other part be QBI, so they must separate out their books and records for the two businesses. The proposed regs contain a de minimis gross receipt safe harbor. So for companies under the 25 million in gross receipts, if a business has an SSTV income that is less than 10% of gross receipts, that entity would not be considered an SSTV. And the reverse effect is for companies over 25 million in gross receipts, if a business has SSTV income that is less than 5% of gross receipts, that entity would not be considered an SSTV. So, and then you have the aggregation of related entities, which is a requirement. The same rules apply on the opposite side of the spectrum. If a company has non-SSTV income of less than 10 or the 5% based on the gross receipts, then the entity is considered an SSTV and there will be no deduction allowed. Now, what if your company has both SSTV services and non-SSTV income? Now, in this situation, at a minimum, we need separate accounting. Generally, companies generating both SSTV and non-SSTV track their books and records together, and with this new law, we'll definitely need to separate the books and records for the two businesses. Now, another consideration is to separate the employees that perform each function. Management employees are okay. We know there's going to be some crossover for management. Now, another final consideration would be consider splitting out the two trades into separate legal entities. So we're going to go into what is consulting. The IRS regulations define consulting as professional advice and counsel to clients to assist the client in achieving goals and solving problems. That's a very broad definition. So technology and software companies may face uncertainty over whether software implementation or advice will be treated as consulting services. Companies licensing software wherein the customer pays a flat fee does not taint the overall business as consulting under the SSTV rules. An example of this would be if you were to advise a potential customer on which software package to choose and then help them with the implementation. If you charge one fee for the initial advising and the implementation and include the software in there, that would not be considered SSTV income. Now, training and education on how to use a software product is not considered consulting. Companies may want to consider alternative billing methods to take advantage of the QBI deduction. And now we have our third polling question.
And great, thank you for taking the question. Yes, the third one is the complexity for partnerships and S corporation and compliance is going to be much more difficult in 2018. A key point of the regs, currently in the proposed regs, the regs state that even if an entity knows that all of its owners have income less than the 315 limit for married, filing joint, even if they are aware of that, they still have to report all the applicable information, such as the W-2 income, the qualified property income amounts, all of that has to be reported. So unfortunately, where you've got a startup company or a company is in a loss, they won't get the benefit of the deduction. And at the same time, they'll still have the compliance burden of putting all the information on the tax return and then splitting that up on the K-1 with the partners. I wanted to revisit again our question or comment regarding what if the company has both SSTV service and non-SSTV income. So for example, if we have an ophthalmologist who is clearly in the medical or healthcare industry, and at the same time they sell eyeglasses or contacts in their front office area. And as we noted, the de minimis levels up to 5 and 10%, but let's assume that our ophthalmologist is performing 60% of medical services and 40% related to the sale of contacts and eyeglasses, which is not providing health care. So in that situation, that would be an example where we would possibly want to look at or consider being able to split the SSTV service out from the non-service income. Because in fairness, the doctor, merely by selling glasses and contacts, should be on the same playing field as the company down the street that is only selling glasses and contacts. So in that situation, again, the proposed regs clearly call for the separation of those two types of businesses. And clearly the regs say, at a minimum, you must track those activities and all the expenses and costs related to that. There must be total separate accounting. So we need to be separate invoices, a separate general ledger, a separate employees, as we mentioned here. And so there are no hard exact rules, but you would want to look at as many factors as possible to prove to the IRS that that is two separate trader businesses and that you're maintaining the integrity of that separate trader business. So the sky's the limit, and we're not saying that you necessarily need to go out and split this into two trades or businesses or two legal entities, but there is some feeling, and there's some court cases out there that do back up prior situations where two trader businesses were under the same legal entity umbrella, and the courts found differently when the two trades were not in separate legal entities. So again, we're not suggesting that, but I think what it does is add one more factor that helps you in differentiating between the two trader businesses. So, as we mentioned before, there are the few downsides. As I noted, many companies are operating at a net loss in their early years, so they get no benefit, but they still will have the increased reporting on 2018 and forward. Also, taxpayers with negative QBI are the ones that have those net losses. They must carry forward that loss and offset positive QBI in the future. So again, it's a good thing because it's similar to the net operating loss situation, but it drastically increases our compliance and carry forward, because if we have to carry forward taxable income, QBI has to be carried forward, and if we have at-risk loss carry forwards, the complexity can be very inundated with additional material that will go to the taxpayer. And again, as I noted, even under the proposed regs, even in the current proposed regs, even if the company knows that all of its owners are below the income threshold limits, they must still report all the applicable info, including W-2. So in the proposed regs, let's look at one specific one. They gave an example. In the example in the regs, we have D is in the business of licensing software to customers. D discusses and evaluates the customer's software needs with the customer. So immediately you would question and say, well, if D is discussing and evaluating their needs, does that rise to the level of being in the consulting bucket? And if it does, then does that taint the overall entity to now be an SSTV and potentially be limited under the SSTV rules versus not being in the service industry? So in the example in the reg, they go further to say that D advises the customer on the particular software product that it licenses. So I want to highlight that. The regs specifically say that they're giving advice on software that it licenses. It does not, and the regs do not address it. What if D was advising the customer on software for licenses of other companies? So for example, if the D is advising on, do I choose QuickBooks or Great Plains or another, then it's not their licenses, and there's the potential that because D is in a consulting or advising role, their business would be consulting and taint it and be limited under the SSTV rules. So going back to our specific one that was in the proposed regs, we have D that's in the business of licensing software. They help the customer evaluate their software. They also then advise them on which products to license. And D is paid a flat price for the software license. They're not paid for a consulting, they're not paid for anything outside of the software license. After the customer licenses software, D helps to implement. Again, we're highlighting is, does that implementation, does that count as a service or consulting? In the specific reg here, the IRS rules that if D is engaged in the trade or business of licensing software, and they're not engaged in the SST in the field of a consulting. Again, if they paid one fee, we'll go back to the example and the facts. They paid one fee that included the implementation, even though they did do advice. So we question that we may want to reconsider if we have some nebulous billing practices where we do have separate implementation costs or we do have separate consulting. We might want to revisit how we bill or how we structure our company to make sure that we don't taint and fall under the more restrictive SSTV rules as a consultant. We also think that if it is, we may need the necessity of splitting those two businesses out so that we make sure that we get our 199 20% deduction on the non-SSTV versus the SSTV. One of the things that the IRS did put in the proposed regs were add some aggregation rules. They're extremely complex, but what they do say is they allow in certain situations where a taxpayer has multiple types of businesses and multiple flow-through entities, then you could possibly aggregate some of those SSTVs to give you a favorable answer. the QBI is calculated on a trader business by each trader business. So if you have multiple trader businesses within the same legal entity, you still would have to calculate the QBI separately. But there's some special rules that if you own directly or indirectly 50% or more of other businesses, none of which are SSTVs, then you do allow some aggregation rules to be made and some elections to be made at the owner level. Those elections are revocable, but they can be made year to year. So again, if you've got that situation, it's very important that you start that analysis now to make sure you understand, and if you do need to aggregate or do need to separate out. So let's give one more example that are in the regs. This one's a little bit more detailed, but if you'll read with me and we can, it makes sense. So F is single and owns 50% of Z, which is an S corporation. F is not an employee of Z. For 2018, Z has QBI of $6 million, W-2 wages of $2 million, and qualified property of $200,000. So we go one step further, is their 50%, F's 50% share of Z is 50% of the $6 million, which is $3 million. 50% of the W-2 wages is $1 million, and the qualified property is $100,000. Overall, in this example, F's taxable income is 1.8. So when going through our calculation, they are clearly over the limit. They are clearly over the income limit, so we know we have to apply the W-2 and qualified property limitations when calculating our final 199A deduction. So first what we do is calculate our tentative 199A, and that's the lesser of 20% of our QBI, which was the 50%. 20 times 3 million would be 600,000. And then we impose the W-2 and property limit, which is 50% of the W-2 wages or 25% of the W-2 wages plus 2.5% of the qualified property. So remember, component 2 is the greater of. The greater of the W-2 limit or the qualified property limit. Finally, we calculate what the 199A deduction, it's the lesser of the 500,000, but here's the catch. Remember, we have another limitation based upon taxable income, and taxable income is 20% of the 1.8. So in this situation, we get down to only 199A of 376. We'll give you a minute just to work the example.
So as an opportunity for everybody on today's webinar, we're going to offer you a complimentary consultation around 199A and the impact on your business. So we'll be reaching out in the next day or so with more information about that.
So with that, we'd like to open up for questions that you may have along the way. One of the questions we got was on looking back at the qualified property. Keeping in mind that the 2.5% calculation is based upon the cost, the unadjusted cost of that qualified property. Well, as many of you know, over the past few years, the IRS has provided a lot of guidance on what must be capitalized. And there was under the current law, technically we could capitalize, we can expense a fixed asset if it's less than $2,500 is the general rule. So for many of us, we went ahead and expensed a lot of equipment, and so it never hit the balance sheet as a qualified property. So one thing, planning opportunities, we may want to revisit that. We may want to revisit and not deduct or expense some of our capital purchases if they're less than $2,500. We want to do just the opposite. We want to put them on the balance sheet as property. We'll still get the same income tax deduction for depreciation because we now have 100% bonus depreciation. So we'll still be able to write it off, but what that does is makes our qualified property count number go up. So again, a tax planning opportunity for us to look and reevaluate on using the de minimis rules to expense. We do not want to expense. So the question comes up, does the deduction on the W-2 wages include all wages in the company, not just those pages? The question is, it does. It includes all employees. So one of the considerations you may, and I know we see this a lot in the technology world, is a lot of companies pay a lot of independent contractors. So they contract manufacture out with someone else instead of having W-2. We may want to reevaluate if we know we have the potential W-2 limitation. We may want to reevaluate some of those individuals that we're currently treating as independent contractors and convert them over to payroll. Obviously, that carries with it the additional payroll tax or benefits, but if you're outweighing the 20% 199A deduction, it may be worthwhile. So to answer the question again, the W-2 wages do include all employees. And so what we see in the manufacturing world and in the, say, restaurant and hospitality, those companies typically have plenty of W-2 wages. It doesn't necessarily capture us. But in technology world, where W-2 wages may not be high, they're outsourcing possibly their R&D or using, again, independent contractors, then we may want to reevaluate that. As a follow-up to the W-2, the question has come up, what does count as the W-2 wages? The IRS realizes there are several different ways of calculating W-2 wages, and they came out with a rev proc at the same time they did with the proposed regs that allow you 3 different alternatives to calculate W-2 wages. The basic or general rule is just taking box 1 wages, but unfortunately with that, the box 1 wages has been reduced for 401k, potentially cafeteria plans, so you may not want to use the box 1 W-2 wage rule. And so this rev proc that's out there allows you to use other alternative and calculate it, which possibly do include the 401k. So you want to get your W-2 wages back up, you would want to reevaluate which of the methods under the rev proc to use.
We're just looking at all our questions here, so just give us a minute. We'll be back with you.
We had another follow-up question on guarantee payments and the effect. And again, we ask that you go back and if you do have guarantee payments in your particular LLC or partnership agreement, that you reevaluate that, noting that a guarantee payment does not count as part of the W-2 limitation, nor does it count as a QBI. So there's much discussion and some of the comments that were made back to the IRS last week dealt with guarantee payments and for the IRS to potentially limit or review that limitation. You can see that there could be abuse in that area, but also some planning opportunities. So if you, again, you have that situation, please reach out to us or your tax advisor to reevaluate that partnership agreement. So with that, we thank you for your time. A very interesting, complex area, but we're also excited about having this new deduction in our pocket. So if you do have any questions, I'm Charles Webb. Please feel free to call us at any time. And Chad Miner here with me, his phone number is also available. Thank you for joining us today.